If you look at the market data going back to the 1970s, public real estate pulled off a massive winning streak. Millions of dividend investors look at that track record and assume that it comes down to hard assets, strong property management, and steady rent growth. But the data tells a completely different story. Because for the last few decades, that outperformance came from a zero-cost leverage trade that was massively subsidized by the Federal Reserve. It was a structural tailwind that artificially forced property values up while systematically driving costs of debt down. But the math of real estate investing just reversed, and most portfolios are entirely mispositioned for what comes next. So today, I will explain what this means for the REITs sitting in your brokerage account right now. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. So, when you look at the standard pitch for REITs, many refer to the statistic that shows that over the last 50 years, REITs look like absolute compounding machines. When you compare the total returns back to the 1970s, REITs, like here the FTSE Nareit index, even frequently beat the S&P 500. As the Motley Fool shows here, REITs have outperformed stocks in the last 50 and 25 years. Many will tell you that this comes from a steady rent growth, hard asset protection, and mandatory and growing dividends. But here's the thing. When you look at the 50-year chart, you are essentially blinding yourself to the macroeconomics. You're looking at an average, not the underlying effects. But when we slice the exact same data into different eras, specifically 3 eras of different interest rate policies, we see that a lot of this outperformance came from the post-Volcker era between 1982 and 2021. During this 40-year window, the 10-year yield, which is basically the gravity for all financial assets, fell from 50% down to effectively zero. This was the greatest bond bull market in all history, and it just so happens to perfectly match the era of REIT outperformance. But that correlation on its own doesn't prove anything. You have to understand the mechanics underneath it, because falling risk-free rates didn't just make borrowing a little bit cheaper. They systematically subsidized the entire asset class. They forced property values up, and the net income growth only made up an estimated 42% of their returns during this time. Okay, so exactly how did monetary policy manufacture this massive premium? It essentially comes down to 2 tailwinds. First, we have to think about how commercial buildings are actually valued. Because they aren't priced like single-family homes based on neighborhoods. They trade purely as income streams based on the capitalization rate, the cap rate. This is calculated by dividing the operating income by the property's market value and gives you an estimation of the rate of return. But cap rates don't exist in a vacuum. They have to essentially compete with the 10-year treasury yield. The reason is that investors demand a premium, a spread, above the risk-free rate to compensate for the work and illiquidity of holding physical real estate. And when the risk-free rate drops for 4 straight decades, the cap rates are dragged down right along with it. Let me show you this in a real example. Let's say you own a property that earns you exactly $1 million a year in rent. If the market demands an 8% cap rate, your building is worth $12.5 million according to our formula. But if interest rates fall and the market cap rate compresses down to 4% while the rent stays the same, your building is suddenly worth $25 million. You didn't do a thing. You didn't raise the rent by a single penny. You didn't renovate the property. But central banks just doubled your asset value by lowering the cost of capital. That is the asset side of the tailwind. But commercial real estate runs on leverage. Because REITs buy new properties by taking on debt. And that brings us to the liability side. Because they usually don't take 30-year mortgages and pay them down to zero. They rely on rolling over corporate debt every 5 or 10 years. If you ever bought a property yourself, you might know this process. Imagine going to the bank and getting a mortgage at 8% in the late 90s. A decade later, it matures and you refinance the exact same principal at 6%. A decade after that, you roll it over to 4%. And every time you refinance that debt with lower interest rates, your interest expense shrinks. And that sudden cost savings drops directly to your bottom line. It artificially inflates your funds from operation, your FFO, and funds your dividend growth. So when we look back at the last 20 years, what was happening is that the property value was expanding by the cap rate compression, and at the same time the cost of debt was shrinking, which in the end pushed the cash flows higher. So even a mediocre management team that barely kept the occupancy rate stable was still looking like an absolute genius on paper because the macroeconomic conditions were doing all the work. But what happens if we strip these macro effects away? What if we look at the raw underlying operational performance without the financial engineering? Well, researchers did exactly this. They took the historical public REIT indexes and mathematically deleveraged them. They looked at the correlation between REITs and interest rates, economic growth, and inflation. They essentially reverse engineered public REITs to match an all-cash private property portfolio. And the results are surprising. Because when you adjust for leverage and remove that 40-year rate tailwind, the historical REIT premium against the S&P 500 statistically disappears. The 40-year outperformance wasn't driven by superior asset quality. It wasn't driven by genius property management. It was a zero-cost leverage trade, massively subsidized by the Federal Reserve. Just think about what this means. Millions of dividend investors bought into REITs thinking they were holding the ultimate safe, hard asset compounder. But underneath the hood, they were actually holding a highly leveraged bet on continuously falling bond yields. This graph shows the inverted treasury yield in orange and the performance of REITs in blue. With this inverted plot, the correlation becomes pretty clear. But science and statistics are unfortunately not that simple and one-sided, and there are also multiple studies that show that the returns of REITs are linked to the general sentiment on the stock market even more so than these macroeconomic effects. And by the way, I put the links to some of my research sources in the pinned comment below if you want to dig a bit deeper. And if you like this kind of analysis and think that it helps your own investing, hit subscribe. On this channel, I cut through the generic hype and objectively look at stocks and macro events to find out what really drives market returns. Okay, so now we understand what drives REIT returns. But how does this matter for the REITs sitting in your brokerage account right now? Historically, investors have demanded a healthy premium of the cap rate over the 10-year treasury to justify the risk and illiquidity of holding physical real estate, as the cap rate spread, the gray graph here shows. But right now, that cap rate spread is sitting at around 172 basis points. That's around 1/4 of the average historical value. So investors aren't being compensated for the risk anymore. The valuation buffer is completely gone. But the immediate danger isn't just the multiple, it's the cash flow. Remember that interest rate tailwind? Refinancing debt at cheaper and cheaper rates? Well, this exact mechanism is now running in reverse. Commercial real estate is facing a massive wave of refinancing of these cheap loans. We are talking more than $1 trillion of debt coming due across the broader sector in the next 2 years. And while the most current numbers from earlier this year show that the peak of this refinancing is already over, it still means that new loans have and will get more expensive for years to come, which already forces some property owners to sell their properties at a loss. And we can also see the jump in interest expenses directly in the operations, because it comes directly out of their funds from operation that has largely stagnated for the last years, as the latest reports from REITs shows. But here we also see that the last data point from the first quarter 2026 finally shows some growth again. Now, if we stop the analysis right here, the logical move would be to sell all your REITs. Please don't do that. Because the management teams actually learned the lessons. The REITs trading today are not the fragile, heavy indebted vehicles that blew up during the 2008 financial crisis. They used the zero interest rate era preparing for this exact scenario and lowered their debt levels. And not only that, the average public REIT has debt maturities that stretch out to around 6 years, with more than 80% of the debt locked in at fixed rates. The interest coverage ratio, so the ratio of how often a REIT can afford to pay its interest expenses from their income, has also increased over the years. The rise in interest rates over the last couple of years is also noticeable in this chart here, but it isn't going to trigger widespread bankruptcies. So in general, REITs today have much healthier balance sheets than they had 20 years ago. But the most bullish argument for real estate right now actually comes from the private markets. Because the high interest rates don't just squeeze REITs. They also paralyze new constructions. And over the last years, the construction of real estate, commercial as well as residential, has declined. So we are walking into a structural shortage over the next 3 to 5 years. And with the long development times in real estate, a constrained supply means pricing power for existing assets. So the REITs that have the balance sheets to absorb these higher costs of capital are going to find themselves operating in a market with virtually no new competition and rising demand. So what does this actually mean for your portfolio? It means that the era of passive real estate investment is over. For the last 40 years, you could buy a broad REIT index, close your eyes, and let cap rate compression and zero-cost leverage do all the heavy lifting. But going forward, REIT returns will be heavily dictated by the sector and the operations. You can't rely on central banks to artificially inflate your asset values anymore. You have to find management teams that actually know how to compound net operating income in growing sectors. I would specifically look for REITs with decent debt levels and a high portion of fixed debt in sectors with a severe supply constraint where landlords have the pricing power. But in general, I wouldn't say that the fundamental investment thesis for REITs is broken. It just requires you to do the work again. And while it might get harder for REITs overall to outperform the stock market, they are still a great source of passive income and have been raising the dividend steadily, even in times where the funds from operation have stagnated. The low correlation of REITs with the total market also makes them perfect to diversify your portfolio and reduce the overall volatility. So while I don't think that we will see a huge outperformance of REITs compared to the general market, they still belong to a well-diversified portfolio. But as always, that's just my opinion. What about you? Do you think that REITs will keep outperforming the market? And which sectors are you watching specifically? Let me know down in the comments. And if you would like to know which boring old dividend stock just raised their free cash flow by 154% and is about to redefine the future of data centers, watch this video next. And of course, this is no financial advice. So please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.